Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Tuesday, the 7th of February. I'm Daniel Lam, your host for the podcast. Personally, I hate working from home. It's very important to get the vibe of the work floor and get a sense of what the colleagues and the clients are thinking. Now, over the last few trading days, as the Hang Seng Index was correcting, the floor had clearly gone much quieter. Investors are basically trying to figure out a dovish Fed, a seemingly hawkish non-farm payroll release, as well as the increasing geopolitical tension between the US and China. In yesterday's podcast, we spoke about our glass half full view on the current risk environment in the US and Hong Kong China assets. Today, let us dig deeper into the implications on FX. The DXY rebounded sharply from close to 100 to around the 103 level upon the blowout NFP figure on Friday. But it's still on a downtrend, with key resistance at the 105.63 level. Should DXY rebound further to close to that resistance level, investors should consider buying other currencies against the US dollar. Powell appeared to be less hawkish relative to our expectations after slowing down the pace of rate hikes. Now, despite the strong job growth number in the US, much of the economic data indicators continue to point towards a slowdown in growth and inflation. So we believe the Fed is likely to be under pressure to cut rates later in 2023, which means that markets are likely to push the dollar lower in anticipation of rate cuts. Hence, we look for a modest downside in the US dollar in the next 3 months, with a 3-month target at 100.5 for the DXY. Now, our upward revision in ECB rate hike projections, along with an improvement in the energy security situation in Europe and positive growth surprise in the last quarter, lead us to revise our near-term euro-dollar forecast to 1.12. A narrowing of real interest rate differentials with the US and positive investor sentiment are likely to be supportive of the euro. We also expect near-term strength in the Aussie dollar, Kiwi dollar, and the Canadian dollar, as the commodity currencies are likely to benefit from the faster than expected reopening in China. Now, as we head closer to the end of Kuroda's term in April, market expectations of a shift in BOJ monetary policy is likely to push the dollar-yen lower. And we have a 3-month target of the dollar-yen at 128 and 12-month target at 127. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.